Happy Wednesday, everyone. Welcome back to another edition of #AskRobCo. Welcome back, James. Hope you're well.
Good, thanks, Rob. Very well.
Good. Let's go straight into it. It's a gloomy, miserable day. The London skyline is pretty miserable. We're going to try and make it look a little bit better and a bit more positive as we work through January, notoriously a challenging month for all, especially the property industry. Let's go through the figures and the data, see where we're at, and start hitting the headline information. So if you have a look at handout 1, there's only one today, the weekly sales figures. Let's go straight into them. We're going to start residentially this week, and then we're going to go into commercial. I know you've been waiting for those figures from last week, so we're going to hit the commercial numbers. What's very clear from where we are the first 3 weeks of data this year is that you'll see the new instructions numbers are just really sluggish. We're speaking with all of the agents, we're seeing the transactions that are coming through, and the year has just started, I suppose, as you would imagine. We're in lockdown 3. People are not putting their properties on the market. There isn't as much activity as we had pre-Christmas. The severity, 1 of the lockdown, 2 of COVID, 3 of January, all combined together, just means that the year is starting out very, very slow. And that's having a knock-on effect across all of the data and intel that's coming through as we speak. Sluggish numbers. Our instructions are up to 250. And remember, we were seeing strong 500s all the way up until December last year. So we're really 50% down on where the market was moving pre-Christmas, and that's a big gap. And really, I'm not thinking that's going to change for another few weeks until the country really gets on top of the COVID position, and we start hearing a change from the government about when the current lockdown is going to be changed, whether that's 2nd, 3rd week in February or that gets pushed to the end of February. I really feel there's a pent-up demand for properties to come on. Homeowners are definitely holding back, and that's having a real knock-on effect on the information and data that we're seeing live. So the sales numbers at 160 this week. Again, that's really in line where it's been the last few weeks. And the week before Christmas, we were over 300 and really hitting high 200. So broadly 50% down there as well. And that's just a real reflection of what we're seeing in terms of the valuations that we're getting through, the volume that there is in the market. This is really key data, really key live information that is telling us the volume of sales that were going through pre-Christmas and not happening currently, and the volume of instructions that went through what are not happening currently. And so that pipeline needs to be rebuilt, and the way it gets rebuilt is by more stock coming on stream. James.
Thanks, Rob. And just to reiterate your points there, it's been a very, very strange and unprecedented last 12 months in the property industry. Those seasonal trends that we've traditionally witnessed have not shone through on the transaction numbers, the new instructions. For instance, as 2020, as we drew to a close last year, the usual traditional slowdown in the UK property market was nowhere to be seen. The market was really hot. Everyone was trying to get their transactions through to purchase. And the latest data we've got, which has been released by HMRC and the Land Registry, shows the extent of this. And it's revealed that the residential property transactions for the UK as a whole for December 2020 totaled just a fraction below 130,000 transactions, which was 31.5% higher than that same period in December 19. And that's really turned on its head the seasonal trend for that period, which has also flipped on its head for the start of Q1 2021, as it's a time when a lot of people will maybe hold off in the Q4 to Q1 to try and get some momentum on the property market as people really sort of start their searches after Christmas, which is not what we've seen at the moment, with lockdowns being prohibitive in that, and our data, which we're bringing you live, is mirroring the inevitability of those current lockdown restrictions.
I think it's a brilliant point, James. The fact that the year ended so strongly in 2020 with an unprecedented volume of transactions, like you just mentioned, with mortgage approvals at near 15-year highs, we are now seeing a lag of that seasonal shift in trend. And so the new properties that normally come on in mid-January, because people have waited for the Christmas season to finish, is just not happening yet. And because of the lockdowns and a bit of nervousness in the market, in that sense, we're seeing a lag. So we shouldn't forget how strong and robust the year ended, and those phenomenal figures in December 2020. And because of that, we're just seeing a lag at the moment. And it will be really interesting next week on the show. We've got a special guest, Peter Ambrose from the partnerships. He's bringing all of the latest conveyancing, deal flow, data and intel from the marketplace. So we're going to hear from him, which, the supply chain, we tell you from a valuer's perspective and working with our lenders and all of the agents, hearing from a conveyancer live with very high level data that we'll be sharing with you of what it looks like on the ground, their pipeline of deal flow, and how they see the next few weeks will be really fascinating. So I'm really looking forward to that next week. I think we're going to get a great spread of data there.
Yeah,
going to move on.
Sorry, I was just going on there just to say that, to reiterate, that last month was the busiest month on record for 10 years. So I'm sure Peter would have been flat out in December, and it'd be good to ask him some questions and queries on that period. Yeah,
all of the lenders, banks, funds listening at the moment, get your questions ready for next week, because getting the one of the top specialists in the market and getting the data from those conveyancing transactions, the fall through rates are so key. The renegotiations, the time period from average deal being 6 to 8 weeks that's now been pushed out from 10 to 12 weeks because of the tremendous volume. All of those nuances are fascinating, and we're going to hear it as live as you get next week. So I'm so excited to share that data with you. I promised you last week that we'd go into some detail on some of the commercial figures for 2020, and we've rounded up the auction room numbers, and the commercial market in 2020 was really challenging, and the numbers that have come through are disappointing, in the sense that the lots offered were 41% down broadly last year, in the last quarter, and across the whole year 30% down the whole year, which is a big hit on that market space. The lots sold were 28% down across the year, and the actually monies raised and percentages sold were all compressed and faced challenges. And that's a real indication of where the commercial market was in 2020. And I say was because we are now seeing some very early green shoots of the commercial market warming up for the reintroduction of transactions, as we hope to get on top of the COVID position and to reopen the marketplaces, whether that's February sometime or moving into March. I believe that 2021 will see the re-emergence of the commercial markets, and improving of those numbers. But just to reiterate, the lot sold in the commercial space across 2020 was broadly 30% down, and that really is a hit. It's a real hit. We saw that as a valuation company that has a really strong commercial department. The volume of transactions for that space was really noted, and that decline is pretty dramatic, and the closing data of 2020 has really showed us that. At the same time, we are hopeful that that market will return. Anything you want to add on that commercial piece?
Yeah, thanks, Rob. I think the commercial rooms, like you say, some of their numbers have been down. Obviously it's been a very turbulent time for the economy and property markets, but it's be interesting to see as we come out of the situation we're in and hopefully into recovery, that will probably coincide with some of the payment holidays on loans and mortgages ending, and also the tenant eviction restrictions being in place at the moment, how that recovery will then coincide with some of those favourable terms, and could that see an uptick in the sort of auction rooms on possibly repossessions, even though we'll be coming into a recovery. So that'll be an interesting one to watch this space on.
It is fascinating, and for all of you in risk and sanction and credit from all of the lenders, banks, challengers that are following, there are so many nuanced markets at the moment that for you to make your decision making, you've got to go really deep and narrow into the evidence that is available. So, using the commercial market as an example, HMOs have traded tremendously well, as well as convenient stores on the high street have performed well in 2020. At the same time, fashion, clothing has really taken an absolute beating as the online sales machines have ramped up their position in those marketplaces. So you've really got to take a very narrow view on the asset class that you're lending on to make that decision making. The same goes with the residential space, in the sense that prime, super prime has performed well in volume, but pricing maybe has gone up with some assets 1 or 2% in certain locations, whether that's the housing stock with outside space in more fringe prime or home counties and regionals, whereas the rest of the market in the country saw a 6 or 7% increase, and again a distinction between flats and houses and outdoor space, etc. And so you can't have a broad brush approach to lending per se, and now more than ever you need to be understanding what markets are performing. So where are you comfortable with your books to be lending, because it's a performing asset class and there's a lot of demand and it's strong, or it's extremely weak and you might be pulling from it or not having so much exposure. So those nuances sit now greater than ever, the specialisms greater than ever. So the depths of due diligence that's required from a lending perspective, and the evidence and the, I suppose, support that you get to make those decisions is greater now than ever before. At the highest level of uncertainty and volatility, which is where the markets currently are, the greater need for transparency, data, intel, and specialist knowledge. So everything we're sharing with you hopefully is guiding you in a positive direction where there are positives, and there are many, and at the same time a few red flags just to keep you on your toes for the areas where maybe you probably don't want to be pushing too much. Last week we also promised, I don't know if you want to add on anything on that, James, before we go to the next subject.
No, I think we've got a few things to get through. We'll move on, Rob.
Great. So the next area that I wanted to touch on that we didn't mention last week was product pricing. And this area is a constantly moving market, and last year saw some fluctuations, some lenders going in quite aggressively, then pulling back. Where are we sitting at the moment with product and pricing, and what is the current trend in that space?
Yeah, thanks, Rob. So there's been a lot made at the moment. We'll start at the sort of entry level pricing of the market. Just to give you some statistics, in September last year, there was around 44 mortgage products available, which required a 10% deposit, so 90% loan to value. Now in the market, this has risen dramatically. We're at around 197 products which offer 90% loan to values in the market currently. So I think that's a space which lenders are drawing on and are sort of as first-time buyers and people that look to take that first step onto the market are getting into. Just a quick note on some of the pricing. I know Yorkshire Building Society, this lender's revealed that they've got a newly enhanced 90% loan to value with rates starting at 3.44% on their 2-year fixed plus fees. I know that HSBC has reintroduced their 90% loan to value mortgage range with terms up to 35 years. So that's some of the sort of market information there of the entry level product pricing in the market.
I think pricing and product is fascinating. Again, it goes back to the previous point that I was mentioning, where you understand the demand is currently and the asset class is performing well, you're seeing a differential in that product pricing. And one of the areas we haven't touched on today is the rental market. And we mentioned it last week, and we had a great guest last week, our specialist on build to rent, where he went into a lot of detail about that niche sector. The more broader rental market and buy-to-let market has really faced a challenging period of time, and now we're seeing some new trends. And we mentioned it last week, I'm going to repeat it again this week. We are seeing that there's take up in smaller units. So small units at the lower price points are getting a greater demand and a volume of transaction. And what we're noticing is that locations next to office space, so being close to where you work so you don't have to commute, is seeing an uptick. Now, it's very early days with that trend, but it would go against standard buy-to-let mainstream trends, which would be your 2-bedroom flat, so you're sharing the rent, near a station so that you can commute to where you're going, and they would be the hotspots and where the market would have been really strong. Now we're seeing some changes in that direction. So smaller units, studio flats next to the office space, so you don't need to commute. And I'm really interested in how that rental market moves and how the rental market price falls over a longer period of time in the assets that aren't in so much demand, then affect pricing. And I think that's a really important distinguishing point to make when you look at generic homogeneous data on sales volumes or sales numbers in terms of your nationwide Halifax indexing. What they don't take into account is the breakdown of maybe the flats market having fallen a few percent and the house market having grown, and all you do is get that general point. So I think that's going to be a great one to watch moving forward, James.
Yeah, it's going to be very interesting, Rob. And like you say, it's those entry-level buyers which form a lot of the volume within the market, but also in terms of activity, we're seeing those people in sort of the middle tier looking to make steps up the property ladder from possibly a terraced house to a semi-detached or detached house with a garden, outside space, and those are the markets which have been active in the last 6 months. And as buyers and their buying trends move towards that, I think product pricing also will move to be more competitive as there's more product available for those buyers in the market. So again, interesting space to watch and monitor how the pricing changes and those small tweaks.
Over the next couple of weeks, we're going to see the lockdown end, whatever date that will be. The market will start moving. So we've got a delayed start to 2021, as we've previously discussed. And then the question, and it's the one that everyone is waiting for, is what happens to the stamp duty deadline? Is it deferred to allow the transactions to get through? Does it come to a complete end? Then what happens to the market? Is it robust enough to carry on? Is there enough buoyancy? Do the government bring in incentives, et cetera, et cetera? Where does the commercial market go? As I've mentioned, we're seeing some signs that everyone's gearing up for return to that space as the hopeful normal or semi-normal or new normal market conditions return. So everything is at the moment under a cloud stroke question mark. All of you are waiting for answers and the guidance and the data and the intel to tell you which direction to go in or which direction the markets are going in. And it is fascinating that we're at the moment in this kind of vacuum pause moment in the market where nothing is really happening. Everyone's holding their position, watching what the next step is going to be. And all those answers and all those questions are going to come out in the coming weeks. And for sure, we're going to be here to give you some guidance. What are the last points for today, James?
Well, Rob, as the UK property market is currently very delicately poised and has seemingly lost a little bit of momentum, with obviously the stamp duty holiday coming to a potential end in the end of March, we all hope that the COVID-19 infection and death rates, they fall to a level which will enable the return of the tiered restrictions rather than the full-scale lockdown which we currently find ourselves in. And once lockdown 3.0, once this draws to a close, could this fuel the perfect property storm of low supply and high pent-up demand, creating a further bounce in the market like we saw at the end of Q2 last year? Or could the increase in stock coming on after the lockdown, new instructions coinciding with the end of the stamp duty holiday, could this cause a more subdued spring market?
Yeah, I think the question is the question that everyone wants to know the answer to. I believe that there is an opportunity for there to be a really buoyant market moving forward. Again, caveat depending on what the government policy is to fueling the economy through property and property investment, which is obviously the fascinating point and the discussion point. I believe that the market will perform this year on the back of that government stimulus. What I don't have clear at this moment in time is what that stimulus is going to look like and what incentives are going to be put in place. The economy needs a driver. The driver needs to be obviously employment, sentiment, confidence, and one of the underlying factors of the economy as a macro is the property, external investment, internal investment, and the government will need this market to continue doing what it's been doing. So I very much hope that there will be renewed pent-up demand, renewed buoyancy, and a continuation of what we saw in 2020. And I think that will be a great economic play to push and drive this country over and beyond what has been the most challenging of 12 months that we have seen in decades, near on 1 decade, but possibly decades. And it's going to get to crunch point very soon, James, and we're going to see what direction that goes. Last point for today, James.
Well, we had a question in last week just about some of the real estate hot subsectors in the market, with obviously within that we've got logistics, which is performing tremendously well, especially on the back of the current trends of Amazon, ASOS, Ocado needing that extra retail warehousing space in locations which are geographically strategic and allow delivery of all its products with people obviously not able to visit high street shops. There's been more spending online than ever, and that sort of circle is a real sort of interesting sector on how that's performed in the last 9 months.
Yeah, logistics and last mile logistics. I think that's going to be a key performer, both in 2021 and beyond. It's reshaping the whole dynamics of distribution, and last mile gets very close to where people are living. So you're in inner city locations, and I think now that a lot of locations have been hurt through COVID and lockdowns, I think you're going to see your distributors and your Amazons, as you mentioned, swallow up all of that empty space, reuse it for storage that needs to get to the market fast, so like fresh foods, goods that need to be stored and kept cool and be very close to their end sale point. So watch that space. I think that's going to be a really exciting one. Nurseries have performed very well over lockdown in the sense that they've been trading. It's a real micro market, but again, one to watch. And there are always other specialisms and nuances and trends that come out of challenging times, and we'll share with you everything we see on the ground and all of those new trends moving forward as and when they happen.
Yeah, and just like we covered last week in the build to rent industry, there's lots of activity there, lots of forward funding, lots of developments coming out of the ground, which will be purpose built as build to rent rather than new build flats, which will come to the market. And it's interesting how closely aligned that sort of model is to student housing, but how differently they have performed in the last 9 months in terms of voids and occupancy rates.
Brilliant. Thanks for everything this week, James. Really appreciate it. Thanks everyone for joining. Next week, Peter Ambrose from The Partnerships, conveyancing specialist, will bring you the live data of all the transactions that are going through, the fall through rate of those transactions, the timings, the delays, the supply chain within the industry. It's going to be fascinating. Strongly recommend you and your teams and your colleagues join. He is going to be giving us the data to share with you. You're going to get very privileged data next week. So really look forward to that. Thank you everyone for joining this week. Thanks for all the questions. Thanks for continuously supporting us on all the platforms. And we will see you at the same time next week, 1 p.m. every Wednesday, #AskRobco. We will see you then. Thank you so much. Thanks, James.
Thanks very much, everyone. Thank you.